I am joined by the great Harley Bassman, Managing Director at Simplify Investments. Harley, great to have you here. You are the convexity maven, master in options. You've been in this business a long time. You just wrote a piece about mortgage-backed securities, how you think they're undervalued, and why that make it even more extreme because of the Federal Reserve. You've been really hit the nail on the head, not only on inflation, but particularly how that will be very bad for long duration bonds. And that's probably, Harley, where I want to start. We can put a chart up, which is just the sort of the drawdowns of TLT, the long duration 20 plus year treasury index. And it's 32%, a 32% drawdown from the highs. And actually, Harley, I think Jim Bianco posted a chart that from January 1st to sometime in April, the Treasury note index had the worst year from January to April since I think something like 1785. So this has been a historic rout in the bond market that even you, a veteran such as yourself, it really stands out. What have you made of this huge sell-off? Why is it significant? And yeah, just tell us what you're thinking about it.
Well, thank you. Great to be here. I will say that Convexity Maven is a self-proclaimed title. It wasn't given by anybody but myself. Let's just hit what your first comment is a little tricky here, and it's your classic fun with numbers. This is why I advise everyone on the planet, aside from taking a writing class in college, is to take Stat 101 to really understand what's going on under the surface here. Very often when you see on the newspapers, if they quote a percent, that usually means they're at least with a very small number. So, if COVID cases go from 1,000 to 2,000, there's a 100% increase. But if they went from 100,000 to 105,000, they wouldn't say percent, they then say went up by 5,000 cases. In this case here, you're quoting the percent decline of a bond or a bond index, as opposed to the yield change. This is a very big deal. What happens is, as rates go up or down, the duration, which means the sensitivity of the bond price to interest rate changes. So when you go back, 20, 30 years and bonds were at, 8%, a 1% move in rate, so from 8 to 9 or 8 to 7, that might only move a 30 security by 14 or 16 points. When you're up at 1.5% rates, you got 24-year DV01, and so a 1% move from 1 to 2 or whatever it might be will move a bond by 24% So you're quoting a percent change here. Most of that is because rates are just so much lower than they ever were before that their sensitivity to interest rates have moved. So I can assure you that we've had much bigger yield moves, from 8 to 11%, or whatever it might be, as opposed to this being from, 1.5 to 2.5, which is not that much per se in rate, but as a price move, it's been gigantic. So let's be clear about that. So yes, end of the day, of course, if you have money invested in a bond fund or some interest rate vehicle and rates have done what they do, yes, you will lose a third of your money, and that has happened. So that's a fact. Will it continue? I think, once again, I'm sure we'll talk about this a little more, is we know, well, people like me know, that inflation was going up, has gone up, is going up, will remain high. Is it going to come off 8 and go to 6? Yeah, sure. But it ain't going to 2 anytime soon. And we know this for various reasons. OER, earnings adjusted rent, commodity prices, labor prices. We don't know if rates are going up. And that I'm very, very clear about, is that we can all be right on inflation, but the seeming link between inflation and interest rates has been broken. Will it return? I don't know. And we could have inflation go up 9%. I can't guarantee you that rates go up for a variety of reasons that we could chat about. And this is very important because it is interest rates that drive the price of bonds. If you have a 30-year bond now yielding 3%, if inflation goes from 6 to 8, and rates don't move, the bond price doesn't move. Your real return changes, but your bond price doesn't move. If you own the FANG stocks that are very rate sensitive, okay, because We know Amazon will make $1 trillion in 30 years. The question is, what's that $1 trillion worth today? That's why you have a PE to go discount those cash flows back in time to the present day. If inflation goes up and rates don't budge, by the way, Amazon price goes up, not down, because they will make nominal earnings higher by definition as inflation is, but the discounting factor won't have budged. So that's a very interesting concept here. You got to be careful when you think about these various things. You have to break apart inflation and interest rates.
Harley, you're the creator of the MOVE Index, a measure of implied volatility for treasuries. So it's essentially the VIX for bonds. That has been going absolutely wild today. I can put up a chart of it now. To what do you attribute that? Is that just the Federal Reserve? Is it pricing in forward hiking, forward guidance, the name of my podcast? And also, is there also a certain flattening and or steepening of the yield curve that's particularly hard to hedge? I heard you say earlier in another podcast that it's if the yield curve twists, that's almost impossible to hedge, and that's why the MOVE Index is going crazy.
So the MOVE Index is the VIX for bonds. It's not quite exactly the same construction. The MOVE is at the money options for 30 days. The VIX is all the options. So the up and down 10%, 20%, 30%, the whole skew of options, which is why the VIX trades a little over an at the money option. But that's a technicality. As far as you're concerned, if you're watching this show, they're the same darn thing. What's gone on over here with the MOVE, and really for every option on a liquid instrument, talking stocks, commodities, FX, bonds, the whole thing, you tend to see 1 month options or short dated options mimic realized volatility. Not always, but in general, on average, you will see implied vol trade 8 to 12% over realized vol. And that's why you have this constant huge selling of 1 month options by so many hedge funds or people trying to go and capture added value and alpha. Because in theory, if you're selling something, let's say 10% over its realized fair value, and you hedge it every day, that's just straight up insurance business. You're selling flood insurance or car insurance, and if you do it often enough and you sell it a little above the actuarial rate, you'll make money. You got to, of course, survive the drawdowns, which are bothersome, but if you size it properly, you'll make money. The reason why the MOVE exploded so much higher, whereas the VIX did not, right? The VIX went from 18 to 28, really, is that stocks went tick, 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 tick. They slid on down ever so slowly. They really have not realized that high of volatility. It's been a slow, grinding decline. 20% is a huge number, but it was slow. The MOVE, once the Fed kind of changed their tune, if you recall, they originally said rates are zero until mid-2023. That was the prediction. Inflation was transitory. We'll keep rates there. They weren't lying. They were sincere. And as Maynard Keynes said, if the facts change my mind, what do you do? The facts changed. It wasn't transitory. Yellen just came out and cried yesterday. I was wrong. By the way, very respectful thing to do. So many politicians refuse to admit they're wrong. No one's always right. You get in the Hall of Fame if you hit 1/3 of your balls for a hit. So she's fine. You've seen massive realized rate volatility, especially in the front end, where twos went from 25 cents to almost 3. That's just a gigantic move, especially in percentage terms. And so that's why the move's jumped up. And the move is coming down right now because we've seemingly found our level. We've kind of found the rate where at least people kind of think we're going to get to 275 or 3. We'll get there next June. And the curve is flattening, which indicates we kind of think we've found our level. We're going to rotate around 2.5-ish, 2 3/4. So that's why the move went up and why it's come down.